You transfer money from overseas, and your Australian bank puts a hold on the funds to ask, where did this money come from? While a frozen account is a significant disruption, it is a standard procedural step, not a signal that you are under criminal investigation. When this happens, the bank requires specific information before they can legally move the funds. Accessing your money depends on providing documentation that details your financial history, details that most people typically keep private. This table categorizes the situation. On the left side are the outcomes people often fear, like tax audits or account closures. On the right are standard anti-money laundering and due diligence checks used to monitor the flow of funds into the Australian financial system. The bank is completing a mandatory regulatory checkpoint, but providing false information or ignoring the request shifts this from a routine hurdle into a documented compliance failure that the bank must report. Banking regulations in Australia require ongoing customer due diligence. This means banks monitor account activity for the entire life of the relationship, not just when you first open the account. This diagram shows how the monitoring software functions. The system establishes a baseline of your typical behavior, like monthly salary deposits. When a transaction, like a large overseas transfer, deviates significantly from that history, it triggers an automated alert. The alert doesn't mean the bank has reached a conclusion about the legality of the money. It simply generates a source of funds inquiry. The bank must investigate these anomalies regardless of how many years you have been a loyal customer. Legitimate life events, such as selling a home or receiving an inheritance, frequently create these unusual patterns. The process only moves forward once you provide the bank with a logical, documented explanation for the change. A common starting point for customers is to name the institution that sent the money. However, telling the bank the funds came from your overseas account at HSBC only describes the immediate path the money took. It doesn't explain how the money was actually earned. This decision tree shows the two levels of inquiry. Source of funds is specific. It asks for evidence of the economic activity that generated the money for this one transaction. Source of wealth is a broader look at how you accumulated your total assets over your entire career. In most routine transfers, the bank focuses strictly on the source of funds. If the money came from a property sale, they need to see the sale contract and settlement statement. A brief note describing the money as a gift often fails to meet the threshold of evidence the bank requires to verify the original source. Providing precise documentation for the specific transaction helps the bank satisfy its immediate regulatory obligation. This transparency often prevents the need for a more intrusive investigation into your overall financial history. Cross-border transfers are subject to specific reporting laws. When money enters Australia from an overseas institution, the bank must file an international funds transfer instruction, which logs the details of the sender and the amount. The bank manages this reporting process internally, typically within 10 business days. This is a standard institutional requirement, and the existence of the report is not an indication that your specific transaction is being treated as suspicious. There is a widespread belief that keeping transfers under $10,000 will prevent the bank from noticing the transaction. In practice, bank monitoring systems do not rely on a single dollar amount threshold. Splitting a single large payment into several smaller transfers to avoid reporting is a practice known as structuring. Banking software is specifically designed to identify these patterns of frequent, smaller deposits. Taking a large legal transfer and breaking it into pieces shifts your activity from a routine event into a high-risk behavioral pattern. This virtually ensures the bank will conduct a more rigorous investigation into the source of the money. Accounts used to receive and then forward money for third parties, especially strangers met online, trigger immediate alerts. These patterns are consistent with money mule activity, which banks are required to stop. Banks also cross-reference every transaction against global sanctions and politically exposed persons lists. If a customer's name matches a name on these lists, even by mistake, the bank must hold the funds until they can verify the individual's identity. If a bank files a suspicious matter report, tipping off laws may legally prevent the staff from discussing the details with you. This often explains why customer service representatives become suddenly vague or unable to provide a timeline for the release of funds. In other cases, the bank blocks a transfer to protect you from fraud. If a payment appears to be headed toward a known scam, such as a romance scam or a fake invoice, the bank may intervene to prevent an unrecoverable loss. While the lack of information from the bank is frustrating, these delays are part of a system designed to manage the risks of global money laundering and protect customers from financial crime. These rules apply even in common situations. If you transfer your own savings from an overseas account, the bank may still ask for employment records or foreign tax returns to see how those savings were originally built. If you receive a large gift from family, the bank may need to verify the source of the sender's funds. Simply stating the relationship is usually not enough to clear a large international transfer. For those who have recently started a business, receiving client payments can trigger an inquiry because that income doesn't match the employee profile the bank established when the account was first opened. In every scenario, the goal is to align your actual economic activity with the customer profile the bank holds on file. Providing documentation essentially updates your records to reflect your current financial reality. Clearing a bank's compliance check does not determine whether you owe tax on the money. The banking system and the tax system operate under completely different sets of laws. As this comparison shows, the bank focuses on the source of the funds to prevent financial crime. The Australian Taxation Office, however, looks at whether the money is assessable income, a capital gain, or a tax-free gift based on your residency and the nature of the payment. Mislabeling income as a gift to satisfy a bank's inquiry will not protect you from a future tax audit. You should treat the bank's compliance requirements and your tax obligations as two separate responsibilities. If the bank contacts you, verify the request before sharing documents. Instead of clicking links in a text message, use the bank's official app, visit a branch, or call the verified number on their website. When you speak with the bank, ask exactly which documents and date ranges they need. Submit clear, unedited records through the bank's secure messaging or upload system. If the bank's handling of the process is problematic, you can use their internal dispute resolution team. If the issue remains unresolved, the Australian Financial Complaints Authority can review the bank's conduct, though they cannot waive federal AML laws. To manage your transfer successfully, verify all requests independently, provide documentation that proves the underlying source of the money, avoid structuring payments into smaller amounts, and track your tax obligations separately. Responding with accurate documentation is the most effective way to restore access to your funds. For complex transfers involving large estates or foreign business income, consider consulting a registered tax agent or legal professional.